Hey folks, welcome back to the channel. My name is Jason, host of Fighting Words Financial, and today I'm going to talk about a particular option strategy that might be really useful right now, and it's called the put spread collar. So a lot of folks are wondering what's going on with the market right now. They've made a lot of recent gains, and a lot of people are afraid that this is some sort of dead cat bounce or it's some sort of bear market trap. And we see a lot more volatility in the markets going ahead. And the primary concern here is that you want to protect the gains you have. So this is actually a bearish option strategy. And in this video, I'm assuming that you know something about options, like you know what a call option is and you know what a put option is, okay? And that's really all the assumptions that I'm making. And if you don't know what those are, I'm going to go over some other videos. You probably want to like and subscribe to my channel so you can get that further information in the future. And if you feel so inclined, go ahead and check out my Patreon as well. I have a really great group of investors there that are completely non-confrontational, very helpful, and they share a lot of interesting ideas, strategies, and information about the stocks that we all love. So number one is, if you have all those concerns that I talked about previously, you probably want to use this strategy to protect recent gains. Number two, use this strategy if you think the stock that you own is going to decline in value. Number three, you think that in the short term, there's probably not much of a chance that the stock you own, the underlying stock in this strategy, is going to rise all that much. And number four, most importantly, is that you're willing to pay the price and assume the risks of this strategy. The basic problem with hedging anything these days is it feels like to me that the cost to buy puts and to really hedge a position in the stock has gotten really expensive over the last decade. That might be my imagination, but hey, we're going to do this the right way, and we're going to use a really expensive stock to illustrate this, partly because it's really fun and I really like the company, but I'm going to use Tesla in this example, which at the time of making this video, the previous day's close was $925.90. So this is my example. So the three steps to this process are very simple. Number one, you're going to buy a near the money put option on Tesla for at least 60 days out, maybe longer. Why 60 days out? Because I want to take advantage of time decay, which is illustrated by something called theta. If you don't know what the Greeks are in options, I'll be making another video on those. It's not really all that important. I just want to take advantage of it. So I'm buying it at least 60 days out. Number two, I'm going to sell an out of the money put on Tesla for the same expiration, but for a significantly lower strike price, somewhere between 15 and 20% lower. The premium that I earn on this option is going to help me offset the cost of the near the money put that I just purchased. So I'm buying a near the money put option. I'm selling an out of the money put option for the same expiration day. Step three is I'm going to sell an out of the money call on Tesla at any expiration to help offset the cost of the near the money put that I just purchased. You can shorten the expiration and roll that call option weekly if you want to adjust in case the stock price actually goes up and we're all wrong about it going down. But let's remember, this is a bearish strategy. What I'm trying to do is guarantee that I don't lose any more money than I have to, or at least pick an exit price where I know how much money I'm going to make. All right, so this is kind of how it's going to work before I actually purchase the options. I just want you to be able to visualize this. Current price is $925.90. I'm going to buy the right to sell Tesla to someone else near the current price at a future date. Number two, I'm going to sell the obligation to buy Tesla at a much lower price, 15 to 25% lower on the same day. And step three is I'm going to sell the right for someone else to buy my Tesla shares at a greater price. So the way this works is as the price declines, these two options right here are going to increase in value, and this one is going to drop. If the price rises, these two drop in value, the puts drop in value, and the call increases. One of the ways that this strategy can backfire on you, though, is that if the price of the underlying stock actually blows through that strike price, you might miss out on some of those future gains because you're going to be forced to dispose of the stock at the strike price of the call that you sold, okay? But let's remember, this is a bearish strategy. You're looking to exit anyway. So step one, let's start buying options. All right. So right here, I pulled up an options chain. I'm always concerned with all of the Greeks here, but in this particular instance, what I'm really concerned with is Delta. I'm buying out 60 days or more in the future here. So what I'm looking at is October 21st, 2022 puts. Right here is pretty much at the money at $920 a share. What I'm going to do, though, is account for some natural variability in price because Tesla is actually a really volatile stock. So I'm going to buy a put option at 900. So I'm buying this Tesla October 21st, 2022, 900 put. That is going to cost me $8,505. It's very, very expensive. That is 8.5% of essentially what my exit price would be. And for a lot of people, that's unacceptable. So what we have to do is to start defraying the cost of this initial put. And that's what we do in step 2 and step 3. Okay. So step 2 is I'm going to sell an out of the money put for the same expiration. What I'm looking at is a Tesla October 21st, 2022 put in one strike price, right? And I want to be significantly lower than the current price. So what I'm looking at here is the 710 October 21st, 2022 put, which is going to get me 2,620. So I spent $8,505. I gained 2,620, helping to offset the cost. So now I'm about 6% down from my chosen strike price of $900 per share, where this is where I could dispose of the stock if the price went down below $900 a share anytime before expiration. So number 3, and this is where you have a lot of choices, right? You can choose how aggressively you want to price this option. And once again, I'm going to be looking at delta over here, and I'm going to choose a delta that gives me that around 0.4, which means there's about a 40% chance that this option is going to expire in the money. And that's acceptable to me. So what I'm choosing is 1,020. I'm going to sell a call option at 1,020 for October 21st, 2022. You can choose to shorten these maturities and roll this weekly. I choose to do everything on the same day. This is almost $100 over the current price, right? And if I sell this call, I'm actually going to earn, in terms of premium, $6,160, which is very, very nice. So what does this option strategy actually cost me in the end? We're buying an option here around the current price of $925 at 900, meaning that I would take a $2,500 loss on this in addition to what I paid for the option. Okay, so I'm actually selling a Tesla October 21st, 2022 put for 710, which if the price declined below 900, I have the choice of either selling the option or exercising the option, in which case I'm going to pocket everything between $900 a share and $710 a share, where I would be forced to buy back that stock. Also, I'm going to sell this 1,020 call. The way I kind of lose on this strategy is if Tesla blows past that 1,020 mark, I might miss out on some of those additional gains. So I win where the stock is anywhere between $900 and 1,020. I might lose some between 900 and 710, but my loss is pretty much limited there. Once the stock goes below 710, theoretically, my loss is everything, because it could decline to zero, but I've pocketed a $19,000 gain, okay? So, and when I say I pocketed a $19,000 gain, that's because the way the premiums work, here's what my cost is going to end up being. So what does this strategy cost me for Tesla? And it doesn't always work out this way. A lot of times you break even or you take a slight loss. But in this case, I bought that Tesla October 21st 900 put for $8,505. I sold, meaning money coming in, $2,620 for a Tesla October 21st $710 put. I also earned $6,160 for a Tesla October 21st call at 1,020. So in total, you would actually make $275 for this strategy if the stock pretty much stayed anywhere between 900 and 1,020, right? You essentially wouldn't lose any money and you make $275 in premium. It gets a little bit more complicated if the price goes over 1,020 or if it drops below 710, okay? So what does this actually mean? So basically, anytime the price declines here, you're looking at these two put options actually increasing in value, and you have a choice. If Tesla drops below $900 a share, you can either exercise that put option and force someone to buy those shares from you, or you can actually just sell the put because it's going to increase in value. You might want to sell the put instead of exercising the shares because it's a smaller taxable transaction, likely if you have a ton of gains in Tesla. If you might want to sell that if it doesn't look like that the stock price is actually going to decline below $710 a share, and you're not going to be forced to buy back the shares at $710. So that is one of the strategies that I would definitely employ in this whole process here. Okay. So if the price rises, though, these puts are going to drop in value, right? But remember, your total cost here is plus $275. Where you really kind of possibly lose out on the strategy is, let's say the stock goes to $1,200 a share. You're actually going to be forced to sell it at 1,020, and you're going to miss out on all those additional gains. And it's going to cost you more to get back into the stock later. So, but let's remember, this is a bearish strategy. You think that there's further volatility in the market ahead. You think there's a very good chance that the market declines or that this particular stock declines. So this is one of the things you want to consider, okay? So I'm going to go over sort of all of what's going on right here and sort of the things you can expect. You can usually end up breaking even on the premium cost to protect your investment, or take a very slight gain or slight loss by employing this strategy. Now, if you think that a recent rally is nothing more than a bear trap or a dead cat bounce, this strategy could really serve you pretty well to protect your gains. The risk, of course, is that the market rallies or the stock rallies further, and the shares that you own are going to be called away when the stock price rises past the strike price of the call that you sold. You're going to miss out on all of the gains above that strike price. Now, if the stock price declines, the puts will increase in value. You can exercise the near the money put and protect your gains, or you can sell the near the money put and just pocket those gains. You can use the gains on the near the money put to either close out of the money put that you sold, or you can also let that out of the money put be exercised and buy back Tesla stock at a lower price if it continues to decline. The bottom line is that you get downside protection. You really reduce the cost of it, but you trade away some of your upside potential depending on how aggressively you want to go with the call option. If you wanted to price that call option more aggressively, I think I bought that at a delta of like 0.4. If you wanted to buy it at a delta of like 0.5 or something like that, you can actually make more money just on premiums than it's going to cost you to like just hedge your bets. But I wanted to leave some room in this strategy for Tesla to actually go up in value as well. But you can mix and match the strategies that you want to take here when it comes to that call option to find the right mix of premiums that works for you. I prefer breaking even or a slight gain on the option strategy to allow myself as much flexibility as possible. But do your own research, come up with your own conclusions. That's, of course, always up to you. So thank you for watching this video today. If you liked it, please don't forget to like the video and subscribe to my channel. Also, check out my Patreon when you get a chance. I'll see you guys next time.